So good morning, good afternoon, good evening, whatever your time zone, and welcome to this, the latest in our series of Fieldfisher Space webinars. We're delighted to welcome a number of distinguished panelists here to talk about the important issue of space finance and M&A. In case we've not met, my name is John Worthy. I head up the team here at Fieldfisher focusing on satellite and space projects. And before we get underway, just a few housekeeping points. There'll be a number of questions which I will pose to our distinguished panelists. And in the middle of those, we'll have a few opportunities for delegates to chip in with their own views on some of the topics that we're addressing. At the end towards the end of the session, time permitting, we'll include a chance to address some questions from the delegates. So if you have particular issues on the topic of space finance that you'd like us to pose to our panel, do please add those into the questions function, and we'll deal with those if time allows. And of course, we'll aim to wrap up within the hour, because we're all conscious that everybody is keen to get back to the front line. So I guess we've seen so much activity in space finance over the last 12 months. Every month, probably every 2 weeks, there are new deals announced. And certainly at Fieldfisher, we've seen continuing strong growth in our space practice. Just over the last 12 months or so, there have been over $10 billion invested in the sector. And it's probably fair to say that these are times of unprecedented change, huge opportunity, accelerating change as markets and technologies evolve, and investor appetite continues to grow with them. So if we just look at the funding scene, only just over a year ago, OneWeb emerged from its Chapter 11 bankruptcy process, and now it's a fully funded non-GSO operator. Satellite View, one of the up-and-coming UK players in the scene, recently closed its 15 million Series A round, focused on innovative thermal imaging services. And Isotropic Systems raised an additional $37 million a couple of months ago for their multi-link antennas due for launch during next year. More recently, we've obviously seen a momentous merger announced between Viasat and Inmarsat, $7 billion plus. That's certainly leading the market in recent weeks. Eutelsat have been involved in a hostile bid, which they rejected, $3.2 billion. And closer to home in the UK, In-Space Missions, another of the UK's growing space businesses, was acquired by BAE Systems, whose CEO said he saw particularly enormous opportunities in space. So they're clearly keen on getting back into the area after a number of years elsewhere. In terms of public listings, well, of course, we're all aware of Seraphim being the first listed space tech fund, raising 180 million, and pursuing an increasingly wide range of investments. And of course, there's been a wave of US SPACs announced, some completed, and the FCA has opened the door to SPACs in the UK as well. But against that background, there are a number of big questions. So where are we heading in space finance and space mergers? Do we see the pace of deals continuing through next year and beyond? And on the SPACs front, has the wave peaked? Are we going to see more activity in Europe? There are a whole host of important questions which we'll try and touch on as best we can in the next 55 minutes or so. So to address these hot topics, I'm delighted to welcome a distinguished panel. David Ford from Silverpeak, Simon Potter from BryceTech, Lewis Jones from Seraphim Capital, and my Fieldfisher partner, Mark Walker, one of our corporate finance specialists. all of them supremely well qualified to offer their expert insights. So let's dive in and look at what are the current drivers for investors in space, and what sort of trends would we expect to see as we approach 2022 and beyond. David, do you want to kick off with some thoughts on that?
Sure, thanks, John. So look, with Silverpeak, we advise companies on both financing rounds and exits, and focused on deep tech, and clearly at the moment we're very active in the space sector. And I guess the question around what's driving investment at the moment, I'd say at a very sort of zoom out level is primarily the very low interest rates that we've had for years, which is driving a lot of money into investment funds, whether it's private equity growth funds, space specific funds, etc. And I think the way we look at the market, the space investment market over the last decade, is that we've had sort of three phases. There's been a phase probably up until about 2016 where you had Bezos and Branson and all these guys investing mostly sort of family money into sort of pet projects, followed by some follow on from the West Coast investors, West Coast growth investors. But then it kind of started to slow down a little bit because there was very few exits coming, and I think all the investors were keen to get exits, and there was very little happening. So it kind of tailed off a little bit, and that was kind of phase two. But I think since about 2019 onwards, it's been, as everybody knows, booming. And I think partly because we're starting to see some exits, partly, as you touched on in some SPAC events, there's also been an increasing number of acquisitions. There's some roll-ups going on, like Redwire and Voyager, who are buying space-related businesses and providing an exit for venture investors, and that's attracting more venture investors. And I think, and we just saw the other day Sierra Space, a 1.4 billion Series A, which is just incredible. And I think, and it's this kind of volume of capital on one side into these funds, and space is somewhat, in some areas, somewhat capex intensive business, and this being helped by that little capital. So I think that's what's driving it. I think we're seeing more and more interesting areas of that capital, where that capital is going in terms of subsectors.
Yeah. Lewis, what's your perspective on this? Obviously, you've been very successful in the listing, and now looking out for investees who will benefit from your funds.
Yeah, absolutely. So thanks for having me on the panel, by the way. Generally, many generalist investors are going after deep tech. They're seeing many opportunities for the decade to come to get some outsized returns. So that's happening, and space has become a pillar of that. People are afraid to miss out. So many people missed out on SpaceX growing very quickly. That's why you're seeing opportunities like relativity space going on to raise vast amounts of cash. I think another element which I wouldn't downplay is the ESG element. Many investors are looking at space as a great opportunity to qualify and quantify the ESG metrics, and I think that's going to attract quite a lot of capital relatively soon. But definitely echo what David said around exits and the low interest rates, and as long as they continue, we expect to see a lot more money coming into the sector.
Sure. Yeah. Simon, do you have any additional angles you'd like to highlight there?
I think on the trends, certainly we're seeing a wider cohort of investors. I think that's leading to a greater level of understanding of the landscape and space amongst that investment community that perhaps roll back the clock a few years, and that was quite concentrated in a relatively small number of investors. That kind of understanding is perhaps a bit more widespread now. I think we see that kind of playing out as perhaps a better alignment of risk and expectations around time horizons of returns and exits. But also perhaps seeing capital being deployed into some of the less glamorous, less headline-grabbing areas of the industry.
Yeah, yeah, and I guess it's obviously fair to say that space finance covers a huge spectrum of domains, from the heavily capital-intensive upstream end through to data analytics, all the services, the IoT services-driven activities, some of which can be generated with relatively low capex. So I guess if we move on then to focus more particularly on UK and Europe, I think we've got a poll here for the delegates to look at what we expect to see in terms of the trajectory of space finance deals in UK and Europe. Are we expecting these to continue to increase, to drop off, or to stay broadly the same? So if delegates could pick which they think is the most likely over the next 2 years, and in the meantime, maybe Simon, would you like to pick up on this one? How do you see the trend line across space finance as a whole in UK and Europe over the next couple of years?
Yeah, I mean, I think if you look at it in kind of isolation, I think there's good grounds for continued optimism. You know, 2020 was a record year. It looks like 2021 is going to be a record year. Not necessarily limited to UK and Europe, but when we look at that globally, I think there would be good grounds to think that will continue. But I think we have to recognise that space, deep tech, any other number of industries are obviously have the potential to be impacted by macro factors here. You mentioned some parts of the industry are very capital intensive. Those parts of the industry have been able to raise capital, as has already been mentioned, in a low interest rate environment. There's potential for that to change and become extremely challenging, potentially even in that kind of two-year time horizon. So plenty of reason to think that we'll see a continuation of this trend, but not to discount potential hurdles along the way.
Sure. Lewis, what's your take as an investor in the space?
Yeah, I think we will see it continue to grow. I think it's great news that we've had ARKITs back, just because it's going to foster a whole load of new talent within the UK and Europe. So I think it's just going to be continuation of large businesses that are fueling new startups as people leave, and we'll continue to see growth into interesting companies. And the likes of ESA want to see positive growth, and so they'll continue to support businesses. And the UK, their new strategic initiative, want to see that growth as well. So I think all stakeholders are aligned on that front.
Yeah. So I guess hopefully we've got some interesting results from the poll, if we're able to display those shortly. David, do you want to add your thoughts on the sort of the likely trend lines in volume and value?
Yeah, I think our, as we'll probably show in a minute, I think our general results from the poll are going to be a bit of a growth, I think. But I would say, although taking the earlier point about interest rates, forecast to go up, and I think everybody expects them to go up, I don't think that's going to have a major impact on investment levels, simply because a lot of this capital is already committed to funds, and once the capital is committed, it's got to be allocated somewhere. And if we did an analysis actually of the dry powder effectively that funds have on hand. now versus sort of 5 years ago, and the time scale of effectively deployment time frame they've got on hand is 4 times what it used to be, and they're also deploying it a lot faster. So there's a lot of capital around, and I think that just means that the deal volumes will continue.
Yeah. I think there's a lot of pointers sort of facing in the same direction. So I think certainly from what we're seeing in our practice, I think there's every expectation that things will continue. So do we have the results of the poll, please?
So I think it's 84% grow, 16% think it will stay the same.
Okay. Yeah. Well, I think that's very much aligned with what the panel felt anyway.
Importantly, nobody thought it would shrink. Yeah.
Yes, indeed. Yes. So I guess we've mentioned the SPACs wave in passing. SPAC mergers have been a really big feature of space finance in the US. But obviously the environment, both the regulatory environment and the market environment, are somewhat different over in UK and Europe. So I guess that raises the question, would we expect SPACs to take off over here, mimicking the US wave? And I guess how far does the FCA's recent announcement make SPACs a real option for space business? Mark, do you want to just kick off with a snapshot of what this FCA announcement really means for SPAC opportunities?
Yeah, sure. Thank you, John. So the main problem with SPACs under UK regulation was that at the point at which a company that had been brought to the market and listed as a small shell with potentially very minimal cash decided to do a transaction, the listing rules in the UK required its listing to be suspended. That principally meant that anybody who had invested in the SPAC couldn't get out, couldn't trade those securities until the securities were unsuspended again, which could be 5 or 6 weeks. In comparison to the NASDAQ and, for example, the European markets, Euronext, that was not the case. So both in the US and in Europe, if you had a SPAC, there were provisions, which are basically the provisions that have been copied now over here by the FCA, which enabled investors to get out at the point at which the proposed transaction happened, and enabled them to redeem their shares. So effectively what the FCA have done is they sent out a consultation document. They then got a fair amount of input back on it. They've now put the changes to the listing rules into place with effect from August this year, so they're in place already. And effectively what they say is that they bring in a requirement effectively for funds to be ring-fenced, the existing funds in the company to be ring-fenced. They bring in a requirement for those funds to be capable of being redeemed. They don't specify how that needs to be done. The company needs to work out how it does that. And there are some other requirements as well, which have to be satisfied. In terms of what this means for the success of SPACs in the UK, one thing they've done, which I think is quite important, is one of their requirements is a minimum capitalisation of £100 million. Now that immediately leads you to somewhat more substantial transactions, and so for SPACs in general, I mean, traditionally SPACs they used to be called cash shells in the UK. I mean, if you go back several years, there's a fancy word for it now, but for years and years they've been so-called cash shells. Cash shells haven't necessarily had to have any minimum requirement or minimum funding requirement. The whole SPAC, the US and the European development, but the US development of them in particular, has focused people's minds on them. But what the FCA have done is they brought in this requirement for there to be 100 million funding, and that will have an implication, because to the extent there are smaller space businesses that might otherwise be the subject of SPACs, then that's not going to work for a SPAC that's got 100 million minimum cap, especially if one assumes that one may well be looking to kind of leverage up on the transaction, because that's effectively the whole reason that you invest in a SPAC, to multiply your original investment. So I think the 100 million threshold is quite important. Interestingly, the FCA were going to make it 200 million, and following consultation, they dropped it to 100 million. Clearly, the suggestion was it should have been somewhat, significantly lower than that. So that's where SPACs are. And in relation to particularly space business, you've got that valuation criteria, which is going to have an impact. Yeah, I guess one needs to see it. It's not going to affect large transactions, but then I think a lot of the large transactions that one tends to see in the space area are done by strategics and are fairly serious and strategic intentions, and they're not if you like, a slightly get rich quick sort of SPAC investment. So query whether this will have the same effect. Why was it so successful in the US finally? Well, answer because just the valuations there were generally much higher, and they didn't necessarily have the same minimum.
Mm-hmm. Sure. Yeah. Thanks for that. Simon, I guess at BryceTech you've obviously got one foot in Europe, one foot in the US. What's your sort of perspective on how far UK and Europe would follow the lead of SPACs in the US?
Yeah, I think it's an interesting question. I mean, I think it tends to go, doesn't it? That UK and Europe follows to some extent what happens in the US. I think when we look at this in relation to space, and to the point there around minimum capital kind of thresholds, there is just the kind of recognition that the size of the companies, typically, not in all cases, obviously, is just that bit smaller in Europe than it is in the US. Perhaps we don't see that in other deep tech sectors, in other technology more generally. Obviously, there are the global giants. We do see that, but certainly in relation to space, there is that consideration. So I think it'll be really interesting to see how that plays out, kind of putting aside investor appetite for any particular kind of transaction type or vehicle for coming to public markets, but just from that sheer quantum of the ecosystem.
Mm-hmm. Yeah. And Lewis, I know your fund has focused on a number of UK and European businesses. Do you see them looking to take advantage of SPAC structures?
I'll be careful with how I answer this. On the whole, the pipe market is generally dried up, and so you're largely just seeing SPACs with a lot of money in trusts, and then having to only raise pretty modest pipes. As a result, yeah, it's just been a lot harder. I don't think we're ever going to see the same pace as we did in Q1 again. Yeah. I think the obvious contenders for SPACs have already SPACed. Mm-hmm. So we're going to see some larger fundraisers, but nowhere near as much cash injection as a SPAC would be towards the end of the year. But I just don't see it replicating the same pace.
No.
European markets are a bit more conservative in general.
Okay. Yeah. Well, I mean, I think certainly it's been a really interesting feature over the last 12 months, and these things do ebb and flow. Maybe we're now likely to see different vehicles, different investment structures taking over. And I guess that brings us on to sort of look at the geographical spread of space investment. So Simon's team at BryceTech identified that last year the UK had the largest space investor base after the US and China, anywhere around the world. So I guess that leads on to ask whether we see UK investors, UK space businesses continuing to account for a large slice of new investment, at least outside North America. David, what's your thinking on that?
Yeah, we track total deep tech investment across Europe, because that's our client base all across Europe. So, and in general, in deep tech, of which space is a part, broadly, there's a broad brush, UK companies get about 30-something% of all investment.
Mm-hmm.
French and German get about 16%, that sort of level, and the rest is a bit of a long tail. And I think it's, my view is it's similar in the space market, and that's helped by the focus of the UK government on space in general, which we'll probably come to, and also the UK Space Agency, grants and so on via ESA. So I think I don't see that abating. I think the UK is pretty focused on it, which is helpful.
Yeah.
But actually, just to add on as well to the last point about SPACs, I don't see the same thing happening in Europe as happening in the US. I think primarily because the US has kind of dried up in SPACs because exactly what Lewis was saying about the pipe market being difficult, and also huge redemptions as well happening in SPACs, and your uncertainty around the actual amount of capital you're raising in a SPAC is a problem. And therefore, I think although the rules have changed, the FCA and all this kind of stuff, I think it will mature. I think it will still be there. It'll be back to the days, Mark, of cash shell companies rather than being sort of glorified as SPACs. They're just back to what they were before. But I think, in general, the European kind of piece is I think the UK will remain certainly as a recipient, and I'm talking about a recipient of investment rather than investor outbound. I think that's the key thing, that will remain probably the largest in Europe, so despite Brexit and everything else. So.
Yeah, interesting. Well, we've got a poll we might just invite delegates to chip in on, to look at how they see the spread or the slice that the UK might take, looking at a number of key territories across Europe, and so if we can invite delegates to look at that, picking if we can move to the other poll, please, looking at UK share of investment, looking at comparison between UK, France, Germany, Italy, and clearly there are plenty of other European destinations that have a nascent and growing space business. But as the delegates pick up on those points, Simon, I picked out the highlight from your report last year. What's your view of the UK's sort of slice of the pie going out over the next couple of years?
I think we don't see any reason for that to change from the perspective, of a continuing kind of pipeline of really exciting UK companies, backed up by, some of the wider factors that have already been discussed here. The UK being a fantastic place to do business, having a great entrepreneurial base, having some backing from the government, which again I think we'll get onto with regard to the national space strategy and that type of thing. But certainly we see no reason to think that pipeline of really interesting capability and talent that has established itself in the UK, no reason to think that's going to change over the next couple of years.
Yeah. Lewis, how about your perspective? I know both Simon and David have mentioned the new national space strategy in passing. Do you see that as a big a big sort of additional tick in the box for the UK as space businesses look for investment?
Yeah, I think it's that intent has probably lacked in the few years prior. I think that sort of just shows how aligned the UK government is. I think particularly following the investment in OneWeb.
Yeah.
So I think they needed that. But we've seen them be a lot more active. They're actively looking for opportunities to give out grants to space businesses. So I think that'll just continue to grow innovation, and sort of following what I said before around when you have large businesses in a certain geography, it breeds other new businesses. So the likes of Spire having a base in Glasgow, OneWeb being in the UK, receiving a lot of investment, Arkit. Between those three businesses, we're going to see many new businesses to come. I think that's really exciting.
Yeah, yeah. And looking at the poll results, I can see that UK is head and shoulders above anywhere else in Europe, 63%. So I think, yeah, our delegates are obviously very enthusiastic about the UK opportunities over the next couple of years. So stepping back for a minute, looking maybe at some of the sort of broader corporate finance market influences in, well, both corporate finance and M&A. As we progressively emerge from the impact of COVID, I guess there's a question: how do we see particular corporate finance trends which are likely to influence how space finance deals get done? Mark, do you want to pick up with a few thoughts on that?
Yeah, sure. Thanks. So I think David and others have already mentioned the the enormous weight of money that's out there, and that I think is probably the biggest driver of trends in terms of M&A and how deals are being done. In that it is, in our experience, it's very often a seller's market at the moment, and that leads to implications in terms of the transaction itself, quite simply in terms of the kind of level of risk that the seller is prepared to take or needs to take. So we very frequently are seeing auction sales where people are being the bidders are required to pretty much take what's on offer. And what we are seeing quite a lot, and I'm talking about the general corporate finance and general M&A market here at the moment, what we are seeing quite a lot is situations where sellers are saying, I think I can get away with actually having pretty much no liability and telling my acquirers that they can take warranty and indemnity insurance, and I'll agree that I own the shares and the business, but apart from that, I won't really give any comfort. That's a direct result, and that and other sort of seller associated protections. That's a direct result of the weight of money and the competition there is for good assets at the moment. Now, that said, looking at the space market, there's a couple of points. One is that the space market is more highly specialized than a lot of others. So while we do an awful lot at Fieldfisher, we do a great deal of, we do a number of sales of tech businesses, and we've sold all sorts of complicated tech businesses. There is nevertheless a difference between a business where you might have assets falling out of the sky and a business where you just might not get communications, from A to B at some point. And the result of that is that it may not always be appropriate for an insurer to give the kind of cover that they would generally give on a normal or a non-space or non-highly technical kind of defense stroke space type deal. So query whether that trend is helping particularly space businesses or businesses of that ilk, where you're talking about very highly complicated assets where actually the insurer may not be prepared to quite underwrite the same risk as they would do on other things. I mean, the other thing, speaking just turning for a moment to corporate finance generally, and looking maybe not at M&A but at investments, and obviously the guys are better placed than me to talk about this. But of course, what we've also seen is an increasing use of convertibles, and in some cases at early stages, we've seen the SAFEs and the ACEs being used. I think the question comes, it's all about the assets of the company and whether the assets of the company are something that are securable or not. It's all about IP, but we are seeing, say, more, increasing use of convertibles in the market. I think the last thing to say is that, of course, in relation to space itself, and we'll probably come to this later, but of course you've got the new National Security Investment Act, and that also is going to have an impact specifically in the space and related satellite sector. So overall weight of money, and I'm sure everyone else will comment probably on that.
Mm-hmm. Thanks, Mark. David, what's your perspective on broader market influences and how that feeds through into space finance?
I think so. We deal with, so when we're advising companies on financing rounds, we're tending to put together a round involving multiple parties. So we're dealing with different types of investors with different types of motives, actually. So on one hand, you've got the growth VC venture growth investors and there's a whole pile of people there. Then you've got the sort of European deep tech players who somewhat are starting to get a little bit priced out, because on average the round sizes are growing. We tend to get involved in sort of Series B and beyond, but in general, whether it's an A round, B round, C round, all of those are going upscale as we go, and as they do, some of the deep tech funds who are maybe investing sort of $5 million checks and so on are unable to get any kind of decent level of control in a transaction from that sort of smaller check. So they've got different motives. Then you've got all of the defense players, the traditional prime contractors and so on, whether it's Lockheed or Northrop Grumman, etc., who traditionally are in the geo and old space sector and are keen to get entrant or get some exposure and activity in the new space market, and so they've got different. And then of course you've got all the Asian conglomerates, whether it's Mitsui, Mitsubishi, IHI, etc., who again, all of whom are keen to access sort of new space areas. So so we're seeing different motives, I guess, is an interesting point from different investors.
Yeah, definitely.
I was going to say one other thing is that also different subsectors, if you like. A few years ago, majority of investment was going into sort of, I guess, fairly normal launch, SATCOMs, remote sensing, and those sort of areas. What we're seeing just in the last year or so, which you wouldn't have seen a couple of years ago, is all the on-orbit servicing and manufacture, the in-orbit servicing, the lunar constellations and so on, and all these sort of things that are a bit more, slightly more out there, and actually somewhat more, I was going to say capital intensive. Some of them are, some of them aren't, but there's an interesting development in the way people are looking at. So
yeah, definitely. Simon, what about the BryceTech view of how the broader corporate finance market influences might feed through?
I think one thing we're seeing, to the point around some traditional investors getting priced out, I think one of the things we've seen, and I'm hearing this directly from companies raising capital perhaps at the lower end, some of the smaller tickets, as a direct impact from COVID, is that they've changed the way that they've been engaging with people. And not to say that it has been easier, but certainly that it has changed their approach to the market, and they've been able to engage with a much wider network of potential investors, because so much of this has been done virtually. and that actually there are, hearing from numerous companies that there are traditional European investors, perhaps from family offices, private investors of some sort, that previously the way they operate would have been that you have to go there in person. It's probably 1 to 3 in-person meetings to even have a conversation. And I think, directly as a result of them not being able to do that from the investor perspective, but also perhaps because they with these rounds getting bigger and perhaps not being able to be quite so picky, that actually companies have been able to engage with a much higher number of people, just because they've been able to set up Zoom calls and do things virtually. So I think we see that at the smaller end of the scale, not necessarily the M&A end, but at the smaller end of capital raising, that feels like that's a trend that may well stick here, not just because of COVID, but COVID playing a decent sized role in that.
Yeah, I think certainly in the way we're seeing transactions handled in our support from a legal perspective. Actually, the fact that everybody's entirely comfortable operating through remote meetings means that there's a much greater efficiency both in the parties and in professional advisors' use of time, and so you can compress the deal timelines if that's what the parties want to do, and everybody can get the deal done and move on and make the most of the investment. Lewis, do you have anything to add particularly in terms of how you see market influences feeding through into space?
Not necessarily. I mean, just the fact that funds that are being raised at the moment are just astronomical, which means that people have to do deals at an insane pace. So there's a load of money being deployed and very quickly, which keeps us on our toes.
Yeah, I'm sure that's right. Yes. So it's really good to hear a variety of perspectives on these sort of issues. Obviously, from delegates' point of view, if you've got particular questions you'd like the panelists to comment on, do feed them through in the questions function, and we'll do our best to address them towards the end. So I guess looking at the space sector, or maybe certain particular sections of the space sector, we talked about broader market influences. We talked about the sort of geographic spread of these deals and the opportunities. What about the M&A and the consolidation market? We've seen the Viasat Inmarsat merger announced very recently. Should we expect to see more consolidation, more M&A in certain subsectors, and if so, which subsectors would you think are the most likely areas for that? David, do you want to have a shot at that?
Yeah, I think security of supply is a bit of an issue in the space sector. So I think some of the players who've got big plans and are reliant on suppliers for whether it's propulsion or avionics or whatever may look to acquire those technologies to secure that supply so they can build faster effectively and get to revenues faster if that's what if they're not already there. But as many of the SPAC businesses aren't already at revenues, so that'll be a focus. And then, of course, some of those guys are very well capitalized now. So I think there will be, and we've already seen actually quite a lot of the SPAC players who have got big cash piles before the redemptions started to kick in, are actually buying things already. Quite a lot of those things, and I guess this kind of the same piece is around things that are particularly long lead items. If you're running missions, that take 3 years to build, if you've got long lead items, you need to get ordered early on. Getting, again, that's a security supply piece, but that's one thing. And I think in the other areas, as we talked about earlier on, there's a variety of different subsectors, and I think some of those are more relevant for acquisitions and others. But yeah, we're seeing quite a lot of activity. So.
Yeah, Simon, what about your viewpoint? M&A consolidation, a growing trend, or just a few highlights in certain subsectors?
No, I think I'd agree with what David said there. It seems very likely. There's a number of companies sat on a lot of capital that's been raised. I think then as well to the point around people looking at supply chains that were, that was in our experience, that was one of the when the global pandemic hit, people looked at the balance sheet. Once the balance sheet was sorted out, they then looked at their supply chains. I think a lot of people found some interesting findings from that analysis. So I think both from shoring up those supply chains, but also kind of vertical integration as a strategy as well. Touched on that a little bit. I think that continues. So yeah, it's I think we probably the one thing that I would add to that is from a constellation perspective, we're seeing these kind of hybrid constellations. Lots of different operators who've perhaps traditionally operated in one orbit, now thinking about things differently, various plans laid out. Acquiring capability is clearly going to be the fastest route to bringing some of that to bear on the market.
Yeah, and the variety of announcements we've seen over recent weeks with GEO, MEO, LEO, all and indeed terrestrial, or the whole sort of communications infrastructure coming together in the way that convergence, which has been talked about for decades, is probably now on the cusp of happening. Lewis, do you see particular M&A consolidation themes playing out?
Yeah, I completely agree. In the SATCOM sector, people are worried about these LEO mega constellations. Everyone thinks they need to operate in fleet solutions. So I think there's going to be one or two more big announcements there with existing large operators or geo operators. I think the other one to make mention of, I think within SPACs, these Earth observation constellations, they're just going to look to acquire maybe downstream solutions if they've been more focused on the data side of things first. So the likes of Planet, acquiring Vandersat, there'll be more there. The other thing is they're under quite a lot of pressure with the public markets to hit their revenue targets. So I see a lot of acquisitions to do with buying revenues as opposed to essentially widening their service there. Yeah. So I mean, there's sensible acquisitions to make there, but I think a lot of companies need to do that to make sure that they don't take a huge hit on share price.
Right.
But otherwise, the other ones have been mentioned.
Sure. Yes. So I guess we talked about the market side. We talked about a number of drivers playing into the space finance arena. But I guess when it comes down to it, brass tacks, then the question is, how should a space business looking to approach a new funding round, maybe moving towards a potential exit or an M&A deal, how should they sort of do their homework and get prepared for what could be one of the largest transactions the business has been through? Mark, what would be your top tips for somebody in that position looking at funding, exit, M&A?
Sorry, can you hear me?
Mark, yeah, go ahead.
Yeah, I'm sorry. My apologies. I thought I was unmuted. It's what you've just said. To get you need to get your house in order, and getting your house in order involves a few things. Most importantly, with any tech business, and particularly with a space business, is it involves ensuring that all your high value assets, and let's start first of all with all your intellectual property rights, are all in the right place, and you can demonstrate you've got them, and you don't find anything out that you don't want to when you're going through the due diligence process. So you're talking there about your assets. Either you've got them under licenses, and that's a very key thing. So a number of people have got rights, or part of their intellectual property portfolio, if you like, is actually rights that they've got under licenses. Well, how solid and robust are those licenses? If you've got intellectual property rights, patents, or other things that you own outright, fine. Make sure that you can show all that. Have you got your employees' IP rights properly assigned to the company? We still see today in earlier stage companies situations where you've got a founder or a technician who's done something, and somehow the company has never got around. The original employment arrangements, very often there wasn't originally an employment agent agreement at the time at which the original intellectual property was created, and maybe something hasn't been put in place since then. So this tends to happen at a much earlier stage. But for heaven's sake, make sure that the company actually owns all the IP rights, and that it's not the employees that own it. Moving on from IP rights, actually then, such other assets that you've got, which are usually contractual assets, so they may not be licenses, but they may be rights to use. And again, how robust are those rights? What sort of change of control are they subject to? Because that ultimately is what somebody's buying. Somebody's buying the unique package that you create, and if there are any chinks in that unique package, then you're going to hit a roadblock as you go down the line, and you're going to have to sort it out in a shorter time period than you would otherwise have to do it. So I think that's the most important thing. Other things to think about are, if you do have a number of employees, if you're not talking at the beginning stage, maybe as you're moving on through the ranks now, you want to start thinking about ensuring that your employees have got employee incentive arrangements in place, and you're locking in the key people, and they're being locked in satisfactorily. And obviously there are tax issues in relation to that. It's too late when you've got a pre-money value of 50 million to start giving people free shares. So that can be a big one too, and too often that gets dealt with very late. The other thing I'd say is that actually, again, starting off from an early stage, what we often find is that when you come to act for an investor investing in a company, actually you've got quite a, because the guy or guys who set the company up, took money from family and friends to start with, might even have had an angel investor group there. You can end up with a very, very widely wide and disparate shareholder base that can be quite unattractive and quite difficult to deal with. And it may be that you need to take steps to ensure that there are certain people who speak for those that shareholder base, and that's not going to be an impediment to you doing the deal and passing the resolutions and other corporate acts that you need to do to get the money in.
Very good. Yeah, thanks for that. Lewis, I guess you probably see a number of your hopeful investee companies knocking on the door. What would be your top 3 recommendations for them if they're coming to you to make sure they're properly prepared?
Okay, yeah. So we now participate in growth rounds, so I look at it from both sides of the coin. But the biggest thing is make sure they consider all funding options. So are they raising the right amount of money? That's often quite contentious because people want to go raise as much as they possibly can, a higher valuation than they possibly can. And so often you can get ahead of yourself, and that brings about consequences later on. So make sure you're considering everything. And now, given there is so much money in the sector, and quite a few funds that want to get involved, a lot of people are knocking on companies' doors. Make sure you do enough due diligence on the investors that you're speaking with, because there is just so much money out there, and making sure you understand how much value they can bring, and where the money comes from is quite important. But generally, as long as you're taking a sensible milestone-based approach and you're raising the right amount of money and you've got good enough investors, and that's as much support as you need.
Yeah, that's helpful. Yeah, Simon, do you have particular points you'd like to flag on this? How an investee should get prepared?
I think the only thing I'd add to that is to Lewis's point that there's a lot of investors out there with a lot of capital, as we've been talking about for most of this call. Once you start having conversations with the investors that you want to work with, I think it's critical then that you've got the defensible numbers to be able to have a very frank and honest conversation around addressable markets, timelines to technical milestones and capability delivery, and then also the capital that's required to achieve all of that.
Yeah. I guess you can't go wrong by being fully prepared, whether it's on the market front, the business, the financials, the legals. That's probably the best advice anyone can give. We had a question in. I think, Lewis, you were talking a little bit about focusing on downstream in Earth observation rather than data. There was a request. Could you expand a little bit on that?
Yeah, sure. Just that a lot of the businesses that have gone to raise SPACs are businesses focused on the upstream. So the likes of Planet, Satellogic, they're still in the process of putting their satellites up and collecting that data, the imagery. Now it's about how to use that imagery to make the most of it, developing insights to sell to these enterprises. The data play can be, you can generate a fair amount of revenues through it, but to hit the valuations that they need to for their SPACs, they need to build a very large revenue base, and the way you do that is by selling insights, not data, and you're making it available to many more businesses.
Yes.
And the best way to do that is to develop tech that can interpret that imagery to turn it into insights, and that's where these operators have so far lacked, but are developing on.
Sure. Yeah.
I think that'll be in specific niches as well. I think they'll be acquiring, capability in insurance or utilities or different areas, because that's where the real people who understand the business can build those insights. And that's
absolutely. None of these are a silver bullet. You need to take in more data than just one modality. So Planet just using optical doesn't necessarily work. They're going to have to look at many different types of data, and that's why Vandersat was quite interesting with passive radiometry. We'll see that with SAR operators, RF, a ton of modalities used in combination, and ground sensors to develop some really interesting insights.
Yes. I think so many domains in this sector are evolving at pace, and so I think the businesses need to be nimble and able to react, applying the technology innovation they've got, maybe in different domains beyond what they had originally anticipated. So I think time is now against us. We're pretty much up to the hour, but I'd really like to thank all of our panelists for their great insight, expertise, sharing some top tips on how they see these space finance deals being done over the next couple of years. Thank you also to the delegates for joining us. We hope you found it interesting, informative, educational. Do fill in the feedback forms, which will be available after the event. And for those who don't already receive our satellite newsletter, then if you'd like to receive that regularly, do let us know. And that'll mean you also get to hear about our forthcoming space webinars through 2022. So with that, thank you to everybody, and have a good rest of your day. Goodbye.
Thanks, everyone.
Bye.
Thank you.
Bye.